Hey traders, Scott Barkley with ProAct Traders. Some of my traders in my live class were struggling with price action, so I asked ChatGPT to give me what are the main struggles traders have with learning it. Brought back quite a few information, so enough that I thought maybe I ought to do a whole video presentation on this. So this is going to be a series of short videos to help you through the process of learning what price action is, how to use it, how to solve the problem in your own case, and how to become a better trader. So let's get right into the video. Okay, trader, this is lesson 4 in our series of struggles with learning price action. Lesson 4 is on time frame challenges. All right, so I asked ChatGPT to give me a list of all the challenges traders were doing, and which we're going through them one at a time. And this is the next one. Different time frames can show conflicting signals, leading to confusion about the overall direction. So time frames are very important. Bankers, that's the big boys, they manipulate the market. They can't control it, but they can manipulate it. And there's always an agenda, and the time frames help us to see the big picture down to today's potential movement. Different types of traders utilize different time frames. So scalpers are on a 15-minute 5 and a 1 looking for 5 to 20 pips. Intraday traders are using a 240, a 60, and a 10, and they're looking for 55 to 150 pips. All right. Swing traders are using the daily, the 240, and the 60, looking for 150 plus pips. And position trading is weekly, daily, and 240 minute, and they're looking for 200 to 500 pips. Now there's an article there. If you want to read it, you'll have to paste it, but write it in. But it's a great article to read why you need to understand that. So what you're looking for is harmony, multiple time frames in agreement with the other charts. So we use top-down analysis to arrive at a possible trading opportunity today. The more the charts are saying the same thing, the better the potential opportunity is. Let's do one. All right, so take a look over here. So here, just kind of a little vector to get it in your mind, day chart. All we care about is where are we in relationship to the high and low? Are we close to the top or are we close to the bottom? That's all we need to know. In the 240, we're looking for structure. It's not tradable due to the time needed to accomplish a move, but it gives us the structure that the market is using. The 60-minute, that's where we live. All of our information once we get down here is to prove what we know from the 240-minute chart. And we finally get the proof of that, then we go down to the 10-minute and do an entry. All right, so I'm here on the day chart, as you can see right here, and as you can see, this is the day chart top right here, day chart top, and day chart bottom right here. Okay, I fibbed it. That's it. You can see they sure know where those lines are, so those are the lines you would use right there. See, all right. Now, when you look at this, we're 2/3 of the way to the top. That means we have room up here. All right, but they've done a 1, a 2, a 3. And if they did a 4 and a 5, we would know it's going to the top if we got a 5th wave, all right? MACD tells you what? You need to be looking for the 3rd wave to continue up here, all right? So if this was going down, already headed down like this over here, right in here, then we would look for the 4th wave and then the bounce for the 5th wave, all right? See, so the chart talks to you each time frame. All right, so here's what we know. We know that we got room to the top on the 240 and the structure is to the upside, all right? Next chart is down to the 240 minute, okay? So here we got a channel on here. You've got it anchored on support and resistance over here. And by the way, you must prove that they know where the heart line is. If they don't show you they know where it is, then this channel will be wrong, all right? So what is the chart saying? Well, there's a big piece of information here which says you possibly have divergence, which means this could be over, or we could do the 4th wave to the downside. Now, here's what it also says. It says, no, up on the big chart, it's a 4th wave, but it's not really, because we've already done a 1, a 2, a 3, and a 4, and we're in a 5th wave already to the upside, all right? So that's what we know, all right? And so traders say, well, why did you use this one right here and you didn't use any of these pullbacks? Because this pullback over here created a flag pattern, which was the continuation plan. This one just pulled back and then went. See that? So that's the fourth wave, right? All right. So, all right, now I'm down here in a 60-minute chart. And what do I see here? I got a fib extension from the pullback on the fourth wave. By the way, that's 180 pips, so it's definitely a pullback and a fourth wave. All right, swing low, swing high to here, and that gives me the targets up here where I'll be shooting for the 1.618 at the top of the channel. The flag pattern is a continuation pattern. However you came into this is how you're coming out. So you can see the flag target is the 618 and the pullback target is the 1.618. All right. So what do we know? We know we have room to the top on a day chart. We know the 240 says the trend is up. We know the 60 says the trend is continuing in a fifth wave, and we have a rectangle pattern for continuation. So we're simply waiting for confirmation of either the rectangle up, complete the fifth wave, or to the divergence to go down, which would mean a breakout out of that flag to the downside. Confirmation comes from the MACD. If we bounce, I'm a buyer. If we break it, I'm a seller. And you can see I'm above the zero line. So when you're above the zero line on the MACD, you are officially a buyer. That doesn't mean you buy, it just means you're officially a buyer. If you're below it, then you're officially a seller. All right? So the higher the time frame, the more confident you can be in it. But the longer it takes to fulfillment. This is why we don't trade off a 240-minute chart, because it could take days, even weeks to finish what it's showing. We live in the 60-minute world. Until we see the confirmation, we go no lower than the 60. We don't, oh, it's going up, I'm going down to the 10, I'm going to jump in. We don't do that. We wait till we see the confirmation on the 60. Remember, big boys trade the 60, so they've never seen a 10-minute chart. Anything you're looking at on a 10-minute chart or any of the other crazy stuff that retail traders do is irrelevant, because the big boys aren't using it. The 10-minute is only for trade execution and for exits. We use A charts with multiple time frames simultaneously to get a handle on the now. All right, so here we go. You can see over here that this is our chart right here. Okay, so you can see here that the scalper, this is a 5-minute chart, the scalpers are buying. These are the intraday boys. They're on a 30-minute chart. They're buying. Here's a 240-minute chart. That's the bankers. They're buying. Down here is another 240 chart. It's Heikinashi. They're buying. Over here is a 60-minute chart. They're buying. Over here is a confirmer chart. That's a 60-minute. They're buying. And in the 10-minute down here, they're just going sideways, getting ready to possibly break to the upside. MACD right here is telling you we are going to make that move. Now, there you go. That's a lot of harmony right there. So what is it telling you? If you went short on that currency, you would most likely lose, since the commitment of each chart is to the long side. All right? Multiple time frames gives you the conclusion, not going and grabbing one. It takes practice to get it into your left brain, but there is no rocket science here. None. Simply channels, Fibonacci barriers, and most importantly, a target that you know the currency can hit. What do you mean a target that you know you can hit? Well, that's why you got to do the work. Here's a trader's work so you can see how to do it. So you can see down here he was working on bull flags, okay? And as he's working on bull flags, he finds out that 91% of them will do what they said it'll do, right? That's what he knows. If he was just working on flags, that's rectangles. 90% of the time, the flag worked. 90% of the time, the flag did the distance into the flag. It did it to the outside. 90% of the time. That's what a trader has to know. He has to know the statistics, and traders don't know the statistics. They're relying on some silly indicator to tell them to buy or sell, and it will not work. All right. So, armed with the statistical validity of the charts, we turn chaos into order. A trader can make a reward for risk decision if their trade comes to them. Anytime you're unsure, rip the lines off. Start all over, because this is how your left brain gets in sync with the market. Multiple time frames tells us the big picture all the way down to the entry or no entry. The more harmony, the more confidence in the setup. So key number 4 is learn to use multiple time frames to become a knowledgeable and successful trader. We'd love to have you watch us do this in real time in a live room. Just go to proacttraders.com, sign up for our 10-day test drive, and you're going to see traders making hundreds, if not more, pips doing what this video is about. By the way, it's free, and don't forget to like, subscribe, and share this video. And by the way, if you subscribe, you'll get notified when I put the next one up. Hope that helps you, everybody.